Welcome to another Southbank Investment Daily. So it is early Tuesday morning, and I'm taking a look at the pound because I think a lot of what's going on right now is going to focus on currencies. So the pound has been hovering here below 125 for most of the last year. So it does beg the question, what's going to happen next? But when we look at more back history, it's probably more correct to say that the pound has spent most of its time over the last few years hovering above 120, and that the 125 level is fairly arbitrary when we think about it over the course of a longer period of time. Now, I do apologize that my Bloomberg is taking time to load the chart, but you can see graphically here that it has bounced from 120 on several occasions, and that it was really the pension surprise crisis in the latter portion of 2022 that caused the price to dip down to 105 or close to 105. So now it has rebounded. But of course, no currency trades on its own. So if the pound is going up, then it means the dollar is going down. Now let's also look at how is the pound doing versus other currencies. So then we can think about how's it doing versus the euro. And against the euro, the pound has basically been doing nothing since 2016. And that was following a significant decline, pricing in the Brexit decision all the way from the peak in 2015. So in order for this price to break higher, then there would have to be a real catalytic event to suggest that the UK economy is going to significantly outperform the EU's or the Eurozone's. And basically at present, it's just pricing in that they're going to be more or less the same. But now let's just think about other currency or ways of thinking about currency. So if we then look at how is gold doing versus the pound, well, we've had a significant run on the upside, and the price continues to hold here around the $1,600 level, and it has broken out of this range that proceeded for about 3 years. So now the big question is it going to hold the breakout and then improve upon it? And I think that the balance of probabilities is quite high. And that's going to bring us to the next big question for currencies. And it's simple enough. When inflation is this high and has surprised on the upside for so long, then the historic targets for inflation are generally about 2%. And when inflation is at 10%, having a target for 2% seems like an awfully long way away. And how high are central banks going to raise rates? And then once they've done raising, how long are they going to keep them there for? In order to get inflation back down to 2%, then they would have to raise rates and hold them there for a prolonged period of time, and that would then greatly enhance the scope for a big economic surprise, or I should say a big economic negative surprise. And obviously they don't want that. So what then appears to be likely is that they'll keep raising rates until something big breaks. Now, some people are of the opinion that that has already happened, that the big issues that arose 3 weeks ago with the regional banks in the USA and the measures that have been underway to intervene have already begun to suggest that the peak in the interest rate hiking cycle is quite close. Now, on the 12th, we're going to have the CPI, and there's a survey that thinks it's going to halve from the last time. But what I think is very interesting here is that the CPI is still around 5%. even with the survey. So the survey is implying that it's going to start coming down. And that would then imply that there isn't nearly as much pressure on the Federal Reserve or other central banks to be aggressive in hiking rates because inflation's already moderating. Now, I think that the one big issue that we have is that interest rates rise, and then there's a lagged effect. The impact of raising rates does not become immediately obvious. And then central banks are working with the available data. And the available data is often lagging in nature, which generally means that they tend to hike rates for too much, for too long. And then that leads to long lags in the data. I think it is much more uh, worthwhile to keep an eye on what's happening with the bond markets. So the 10-year yield is hovering here in the region of the upper side of the underlying trading range and the region of the 200-day moving average. And it dipped down below it last week, but then it paused over the last few days. And a good reason for that is that unemployment in the USA is not rising. And the two main mandates of the Federal Reserve, well, in fact, the only two real mandates, they've got lots of other responsibilities, but the two mandates are for growth and high employment. So they can keep raising rates until unemployment starts to rise. Well, we're at this decision point then. Either they're going to continue to raise rates, which would support the dollar, and then raise the interest rate differential again. Or they're already close to a peak in the interest rate cycle. Therefore, other central banks will have caught up with them, and then the dollar will go down. And if they are close to the interest rate hiking, the peak of the interest rate hiking cycle, well, then bond yields should start to break lower from where they are right now. So we really are at the decision point. And that is going to have a material impact on lots of other asset classes. But one thing that I think is particularly interesting right now is that Bitcoin is breaking on the upside, and it is back above 30,000 for the first time since May of last year. Now, if we zoom out and look at more back history, well, now we can see that there was a fairly well-defined base. It was completed. Now it is pushing up again. The 200-day moving average is on the cusp of pushing up through the 1,000-day moving average. Now, there have been some significant trend inconsistencies with Bitcoin because it did dip back below the peak from 2017, which was the peak of the last big surge. And it had never done that before. So that was a material difference. Then, of course, there's the additional point that it did not go up as much on the last occasion as it had during other big bull cycles. But we are a year out from the halvening, and that limited supply argument is going to become more powerful as we approach it. And the last halvening was in about May of 2020, and a year before it, prices were very depressed and then rebounded. So that's what I think we're seeing right now, that bargain hunters are pricing in the potential, that, or at least they are positioning themselves now for the eventuality that prices will do this again. And that would be at some point in late 2024 or potentially 2025. But because prices are lower now, then you do have some traders that are positioning themselves for that eventuality. But the thing that I find most interesting is that Bitcoin's a liquidity barometer. And this renewed interest is also suggesting that we're going to see the peak in the interest rate hiking cycle soon, and then interest rates will come back down and liquidity will start becoming more available. That's also why stock markets are up in very early trading. We have pretty much green right across the boards. And that is certainly suggestive of risk appetite beginning to return here. But that doesn't mean there's not going to be a recession. The only way that interest rates are really going to come back down is when unemployment starts to rise. And that is a condition for a recession. So while we have the potential in the short term for a rebound, then I think this is much still more of a trader's market than an investor's market, and caution is warranted. And I think with that, I'll leave you for this week and wish all the best to all of you.